we believe the negative growth rate will continue, if not accelerate to the downside, during the next 3 to 6 months.
Hey guys, welcome back to Library of Wealth. Today we have the latest interview with the CEO of ARK Invest, Cathie Wood, giving us a market update for 2023, as well as many economic indicators that have transpired since the FTX collapse. On Thursday, ARK Invest sold 403,990 shares of Silvergate Capital as the firm plunged by more than 40%. The sale nearly liquidated the firm's shareholdings as ARK dumped 99% of their position. The same day, ARK Invest acquired $5.8 billion worth of Coinbase shares, which Cathie Wood still shows confidence in despite the crypto exchange's share price falling by 11%. She remains bullish on the crypto industry and centralized exchanges despite the more than year-long bear market we've seen. Interestingly, Coinbase's stock plummeted about 87% since last year, and this is the second time ARK Invest has acquired shares in the company since November of last year, despite turbulent markets triggered by the FTX collapse. Let's check out the latest interview with Cathie Wood as she talks about her outlook for 2023 and what economic indicators we can expect with inflation and the stock, crypto, and capital markets in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
This is a very unusual period. In fact, in my career, I've never seen it go negative, and I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of real-time indicators, a lot of market indicators. When I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So, zero negative is a huge departure. And we believe highly deflationary. And we're beginning to see that, as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. We have been through a massive supply shock. And this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. The stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline. And we'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points, so we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices.
Wood believes the Fed rates will decrease by the start of next year because the economy is showing signs of extreme weakness. Cathie says while it's good and bad, and while it's a bigger risk than inflation, she's already seeing cyclical deflation in the pipeline. Wood believes another signal that more economic hardship for Americans is coming is the Federal Reserve's use of lagging indicators. She says they're making a huge mistake with their monetary policy, and unless a pivot happens, deflation is a certainty.
We've had a lot of dislocations associated with supply chains recently, so it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely when you take all these factors into account. That's not very much. We had better hope that inflation continues to slow. Most of the inflation indicators we've gotten in the last 2 months have been better than expected. And the Fed's beginning to mention that, but isn't buying into it yet. So we're in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms, taking account of inflation. We also got another number today, ISM, for the service sector. It's a diffusion index where anything below 50% suggests that the economy is contracting. And the most important number in that report was orders, always is. Orders dropped 10 percentage points, very sudden and very rare for this index. And as you know, services are a much bigger part of the economy than manufacturing. So that drop off in orders is reminiscent of what we saw during 08-09. And not at all what we saw during the COVID crisis. So much worse than that. And I think we're probably, in response to that, going to see more layoffs in the service sector and probably some of these employment metrics turning a little bit more negative. The orders number corroborates what we saw from factory orders for the month of November. They were down 1.8%, and even more important, the previous month was revised down from plus 1% to plus 4%. So again, at turning points, we look at revisions. And while we think that when history is said and done, the recession started toward the beginning of this past year, most statistics are still conflicting. And so that's why I'm saying at turning points.
Although not everyone agrees that this is the wisest course of action for the U.S. Central Bank, investors are more confident that we will see a third consecutive 75 basis point interest rate increase, which according to Wood will have catastrophic implications on the economy. If the Federal Reserve keeps hammering the economy with interest rate increases, in her opinion, we are guaranteed to see deflation. What do you guys think about Cathie Wood's economic outlook for the next few months, and how deflation might be a bigger risk to the market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.